On Wall Street, there's 5 levels that you can progress through to really get to the end of your career path as an investment banker. So in this video, we're going to go over each of the 5 levels, how much you get paid at each level, how long it takes to go ahead and get promoted at each rung, and then ultimately what you really do at each level. And then lastly, we're going to talk about what actually separates people who end up going down that path and trickling through to managing director level versus the others that end up ultimately leaving. So level 1 is the analyst level. This is where everyone starts. If you're coming out in college or if you're lateraling from a different career path, you'll end up at the analyst level. That's the most basic junior level at an investment bank. But surprisingly, that's also the level that ends up putting in the most amount of work for what the client actually sees. So those pitch decks, those PowerPoints, pretty much 80% of the work that ends up making it to the client is done by the analyst. So as an analyst, you're not in the room actually negotiating the deal, but you're building everything that the people in the room are presenting. The typical analyst program is 2 to 3 years. Some banks do have a formal 2-year program. That's case dependent from bank to bank. And then after that 2-year program, it's agreed upon both the employee and the employer that you'll just go off to do something else after those 2 years. So first year analysts at bulge bracket banks are making roughly anywhere between 100 to 120,000 in base with about 80 to 120K in bonus. That puts you somewhere around the 180 to potentially $240,000 mark all in, which is not too bad for your first year out of college. By your third year as you can consider that a senior analyst, you could be pushing $250,000, potentially even at some banks. It's a bit more rare, but you can get to the high 200,000s level as well. Now, the thing is, when you actually divide this by the total number of hours that an analyst does work from week to week, this ends up being a much lower rate per hour. And that's just because the hours are the worst at the analyst level. So from bank to bank, you can typically expect to work somewhere between 70 to 90 hours per week. And some weeks even get as bad as 100 if you're on a very aggressive deal that has very aggressive timelines. Now, again, that's also case by case. It really just depends on the deal team you're working with, as well as the type of engagement that you're working on. If the client is a bit difficult to deal with, that's just going to result in more hours for you. I've been on deals where the work-life balance actually is much better than those common hours that are quoted, but I've also been on deals where it's pretty accurate. Now, the most important part about all this is at the analyst level, which would be most people that are watching this, there's probably about 80% the analyst level that end up leaving after 2 years or just don't end up getting the promotion. And so it's very common for individuals to trickle out at the analyst level. Now, after the analyst level, most individuals go off to private equity, which is what I ended up doing. Others go off to hedge funds. Individuals that don't want to work as much, private equity and hedge fund path maybe isn't necessarily the best option. So what they'll end up going ahead and doing is joining maybe a corporate development firm, which happens from time to time as well. On corporate development, the hours and lifestyle tends to be a bit more friendlier than some of the other typical finance careers as well. So now we can talk about level 2, the associate. At the associate level, these are typically, most of the time, they're going to be analysts who got promoted. And then sometimes they're also MBA graduates that are hired directly into the role. And this is where the job kind of starts to change a little bit. As an associate, you're doing technical work, but you're also managing the analysts below you. You're the project manager. You're reviewing the models instead of building them from scratch. And you're the one who catches the mistake on page 47 before the VP sees it. This is also where you start to get real client exposure. So this is pretty important because now the other part of your job is acting as a bridge between the analyst that's doing most of the technical work, but then also between the VP, director, MD, as well as even the client sometimes. And so you're communicating between the two and trying to make sure deadlines are oftentimes met. So this level typically lasts about 3 years, and the comp jumps quite a bit. Associates earn roughly 200 to 250K base with 100K to 200K plus in bonus. Now, the 200K end is obviously a bit more rare, but that typically puts you at a total of anywhere between, call it high 200 to potentially upwards of 400 grand, all in, depending on your year at the firm. Elite boutiques, top bucket associates can clear $400,000 to $500,000 annually. Now, as far as the actual hours themselves go, it does get a little bit better, but especially in my experience and what I've seen, it's not really definitely noticeable at that point. You're still working very similar hours to the analyst. And I would say the pressure jumps up quite a bit just because now you have a bit more pressure to manage the boss's expectations as well as sometimes even the client's expectations. So the analyst is oftentimes shielded from that. You could still expect to work up to 75, 80 hours a week as an associate, but on better weeks, you can think about it more like 60, 65 hours per week. Now, if you keep following this evolution and you get promoted from the associate level, that brings you to the VP level. Now, this is where things change completely from when you were an analyst. At the VP level, you still have to have somewhat of an awareness of what's going on technically with the work that's being done, but a lot more of your time is spent on the communication side of things, dealing expectations with a client, and then obviously with the managing director as well. So it's essentially the same progression from the associate, and now it's just much more enhanced. You really are spending most of your time here on the communication side and bridging the gap between the two rather than just the technical side. The VP runs the deal day to day. You're managing the entire work stream from analysts, associates, timelines, client deliverables. You're the one pretty much making sure that the pitch book is good to go and everything that the client asked for is already in there and you guys are good to go. So at the VP level, this typically lasts about 3 years. So the comp, you can expect that to be somewhere between 250K to 350K base with 150K to 350K in bonus. So total comp comes out anywhere from roughly between $400,000 to $700,000. So the other point here to say about the VP is this is the level where most of the people get stuck. A lot of bankers make VP and then they either plateau because they can't make the transition from execution to origination, or because the next promotion requires you to prove that you can bring in revenue, and not everyone can do that. And so this is also the next big phase where you start to see people trickle out because it's a very different skill set that's required to excel at the VP or the director level, where you're now actually starting to work on the origination side and you're dipping your toes into the deal development side of the business as well. You need to kind of becoming a producer now rather than just doing well on the technical work. And so that's where really a lot of candidates decide they want to leave the investment bank and potentially go focus on something else now because they're just not really fond of bringing in too much deals or going ahead and originating new business. And now at level 4, you have the director level or sometimes the senior vice president level. So this level goes by different names at different banks. Some call it director, some call it senior vice president, some call it executive director or principal, but the role is the same everywhere. You're a managing director in training. At this level, your job is shifting dramatically towards business development. You're still overseeing deal execution, but your primary value to the firm is now your ability to originate new business. You can get in front of a CEO and convince him to hire your bank. You can identify a company that should be thinking about selling and proactively pitching to them. You can also build a network of private equity sponsors who call you first when they need a sell side advisor. So those are the most typical things that you really start to transition to, and that's what helps you get on track to become an MD. Now, that's typically where the level where people start to see that they could become a lifetime banker and make it to the managing director level. If you're able to do those things and you actually, quite frankly, enjoy doing them, then that's when you really know investment banking is the career for you, and you could probably stay long-term at the investment bank. Now, as far as the comp goes, this ranges typically between 500,000 in base to 1 million plus total, depending on the firm and your deal generation. Some banks explicitly tie director comp to individual revenue production, so the revenue spread can be enormous. Now, lastly, you have the managing director level. So this is the top of the mountain. This is what it takes about 12 to 15 years of banking to build towards. And if you look at the numbers, fewer than 5 to 10% of analysts who start will ever get to this level. The MD's job is to simply bring in deals, and that's really it. You're the rainmaker. You are the face of the bank to the client. You're the person that takes the CEO to dinner. You build trust over the years and get the calls when they're ready to sell their company or raise capital. The modeling, the pitch books, the all-nighters, that's what your team of analysts, associates, and VPs handle. Your job is to make it rain. Compensation at the MD level is where things really kind of unpredictable and a bit more wild. Base salary is typically 3 to 450K, 300 to 450K, which almost doesn't matter because the bonus is the real number. Junior MDs who are still building their book might make 900,000 to 1.5 million all in, but tenured MDs who are producing regularly, that number looks more like $2 to $5 million. Top rainmakers and group heads at the biggest banks, sometimes even 10 million, plus significantly more. Now, the drawback here is the MD seat is not necessarily stable. There's a lot of volatility at this level, and that's because almost all your compensation is tied to deal origination and the actual revenue that you bring into the firm. Now, if you have certain bad years, that's going to bring a lot of pressure to you because there's a good chance that you are now going to be on the chopping block. So when you're an analyst, associate, even VP, a lot of your work is still fine. It's tied to technical modeling and all that. But you just need to go ahead and execute well, make sure there's no errors. On the deal origination side at the MD level, if you're not bringing in revenue, then you're going to most likely lose your job, especially if you haven't been able to produce anything for, 3 years. And then the last thing to understand about MDs is a large portion of their comp is also deferred. Sometimes it's even 30% or more of that comp is paid in restricted stock or deferred cash that ends up vesting over 3 to 5 years. So that 3 million number on paper might actually be 2 million in cash and 1 million in stock you can't even touch for 5 years. And if you leave or get pushed out before the stock vests, then you won't even have access to that stock anymore. So you actually didn't even end up making that money. If you're thinking about getting into banking, then go ahead and subscribe and we'll put out more videos like this.